You don't need the fastest investment portfolio. You need a portfolio you can sleep with. Let's build a safety-first setup together, one that's designed to handle real life, not just chase market highs. It's built on 3 simple pillars: a solid cash buffer, a core of boring stocks, and one extra stream of income. This isn't about getting rich tomorrow. It's about building a foundation that won't crumble when life throws you a curveball. You don't need maximum speed. You need a setup that lets you grow steady, under clear skies, without the constant stress of financial storms. This approach prioritizes peace of mind over risky bets. So let's get into how it works. Before you even think about buying a single stock or ETF, you need a cash buffer. This is your first line of defense. Think of it as a safety net under a tightrope walker. It's the emergency fund that protects you from life's unexpected tumbles. Start small if you have to. Your first goal could be just 1 month of essential living expenses. Then build it to 2 months, and then 3. The ultimate goal for many is 6 months, but every dollar you add makes you stronger. This buffer is what stops a broken down car, a surprise medical bill, or sudden job loss from turning into a full-blown financial crisis that forces you into high-interest debt or forces you to sell your investments at the worst possible time. It's the most important non-negotiable step. Once your initial buffer is in place, it's time for Pillar 2, your boring core stocks. I say boring on purpose because your core portfolio should not be exciting. This isn't where you chase hot picks or gamble on meme stocks. Your core is built on broad, diversified investments like index funds or global ETFs that track entire markets. Think about funds that hold hundreds or even thousands of different companies across various essential sectors like technology, healthcare, and consumer goods. They still move up and down with the market, of course, but their risk is spread out. Their performance is based on the collective growth of the entire economy, not just the hype surrounding a single company. This part of your portfolio is designed for steady, long-term compounding, not for a quick thrill. And just to be clear, this is for educational purposes, not specific stock tips. Always do your own research. Now for the third pillar, which acts as an accelerant for your entire plan: one extra income stream. Notice I said 1, not 10 side hustles. The goal here is focus, not burnout. Pick one skill you have, maybe it's video editing, writing, tutoring, graphic design, or consulting, and offer it to one specific type of client. You're solving one clear problem for them. This isn't about building a massive business overnight. It's about dedicating a few focused hours each week to turn your time and skills into extra cash. This targeted approach is far more effective and sustainable than trying to juggle a dozen different gigs. It provides a reliable boost to your finances without destroying your health, your social life, or your performance at your main job. It's about creating a manageable, predictable flow of extra money. So how do these 3 pillars work together to create a powerful, resilient financial system? It's all about having a clear plan for your money. Think of it like a flowchart. The extra income you generate from your single side hustle has a specific job to do. First, it goes directly toward building up your cash buffer until it is fully funded at least 3 to 6 months of expenses. Once the buffer is solid, that extra cash is redirected to its next mission, aggressively paying down any high-interest debt you might have, like credit cards or personal loans. Killing that debt is a guaranteed return on your money. And finally, once your buffer is full and your bad debt is gone, that extra income stream gets a new permanent job, automatically feeding your boring core investments. This creates a virtuous cycle where your side income consistently accelerates your long-term wealth building. So, where do the exciting high-risk assets fit into this safety-first model? Things like individual stocks, cryptocurrency, or other speculative ideas. They aren't banned, they're boxed. You create a small, clearly defined risk box that is completely separate from your core plan. This box gets a small fixed allocation of your investment capital, maybe 1 to 5%, an amount you would be completely okay with losing. This is your designated area for speculation and learning. By containing risk in this way, you give yourself the freedom to explore higher growth opportunities without ever jeopardizing your core financial security. If the assets in your risk box go to zero, it's a lesson learned. But it doesn't affect your ability to pay rent, buy food, or fund your retirement. Your life's plan remains intact. To make all of this work without becoming a full-time job, you need to swap random check-ins for simple rituals. You don't need to stare at stock charts every day. That often leads to emotional, panicked decisions. Instead, schedule 2 simple appointments with yourself. First, a 10-minute weekly money check-in. During this time, you just glance at your accounts. Are your automated transfers working? Did you stick to your budget? Second, a 30-minute monthly review. Here, you take a slightly bigger picture look. How is your cash buffer growing? Is your debt principal shrinking? Are your core investment contributions happening on schedule? These brief, consistent rituals keep you in control and focused on the metrics that actually matter for long-term success, replacing anxiety with calm, steady progress. Rituals always beat randomness. When you start thinking and acting this way, a powerful identity shift happens. You stop chasing lottery tickets and get-rich-quick schemes. You start behaving like the calm, rational CFO of your own life. You become a safety-first builder, someone who understands that true wealth isn't just about growth, but about resilience. It's about building a financial structure that can withstand the inevitable storms of life and still come out stronger on the other side. Remember, this video is for educational and informational purposes only and should not be considered financial advice. Please consult with a professional for your specific situation. If you want to learn more about building wealth that actually survives the realities of real life, make sure to follow and subscribe. Thanks for watching.